I'm going to get started today by addressing some issues and some common questions that we've been getting on the annual financial report. If you check your calendar, that is due on March the 1st, which is just 18 days away. So the countdown has begun. If you haven't already submitted, if you haven't already started, you need to be thinking about that because we will be looking for it by March the 1st. And if we don't have it by that time, then that sets off another chain of events that you can all avoid if you get it submitted on time. One of the first questions that we've been getting on the annual report has to do with conduit debt. Questions like what that is and how does it get reported, what does it look like on the annual report. And we've trained on this previously, so I'm not going to go into a lot of depth here. If you need more information, I know Susan's trained on this within the last year in getting ready for the changes to enhance regulatory and the reporting in the annual report. So if you want to check out some of those trainings of what she did, those are really good. They would have been anytime last year, probably midsummer and in the fall. And those are on our website under the presentation and materials section. You can find those old recordings and PowerPoint materials. But when you get in your annual report and you're answering the unit questions, and you get down to number 19, that's the one that covers conduit debt. And it simply asks, do you have conduit debt? It explains it a little bit. If you click yes, you'll be asked to, or you'll put some narrative in the comment box. So question 19A there is describe your conduit debt. I have a sample in it that I just typed in of kind of, you don't have to get too wordy, but I typed, we issued economic development bonds and loaned the proceeds to a borrower to provide financing of facilities. There's no obligation to the city, and the outstanding conduit debt at 12/31 was $4,321,000. So keep in mind, conduit debt is an instrument used in the name of a city or a town that's for the benefit of a third party that is primarily liable for the repayment of that debt instrument. So if the reporting entity, if you have any conduit debt, the things you'll want to put in the text box include a general description of the debt transactions, the aggregate amount of all conduit debt obligations outstanding at the financial statement date, which is going to be 12/31 of 2021, and a clear indication that the issuer, a clear indication that the issuer doesn't have any obligation for the debt beyond the resources that are provided related to the leases or loans. Tax abatements are another area that have generated more than a few questions. You're going to see it first in unit question number 17, where it asks if you've been affected by tax abatements through direct or indirect agreements. A tax abatement is an agreement between your city or town and possibly other governments and an individual or company in which a promise is made to forego tax revenues, and the other party promises to take specific action that contributes to your economic development or benefits your citizens. So as an example, let's say I'm a town and Susan promises to build a warehouse in my community, and it's going to employ, when everything is said and done, it's going to employ 25 workers. So in exchange for Susan deciding to build her warehouse in my community agrees to forego the tax revenues for a period of time. So the requirement is to disclose in a note to the financial statements the amount of taxes that have been foregone. And this is how it's going to look when you get into the annual report itself. When you answer yes, it will generate a section called tax abatements, and you'll need to complete that. If you get there and you go, wait a minute, we don't have any tax abatements, then you need to go back to the unit questions and change your answer, because if you answer yes to that unit question, it's going to generate this section. And if you answer no, you won't see it. So if you answer no, but you do have tax abatements and you're looking for it as you're doing your report and you wonder where it is, it's because of how you answered the question. And you want to keep in mind there are direct abatements and indirect abatements. So that top box, the top green arrow, is where you're going to put your direct abatements, and the bottom is where you'll put your indirect abatements. Basically, direct abatements are those that are approved by your councils. Indirect abatements are going to affect your city or town, but they're not ones that are approved by your governing body. They're ones that are authorized by another governing body, most likely your county councils. And because there's an impact to your city or town, then these indirect abatements need to be disclosed as well. So let's take an example and go through some of the information that you'll be needing to get from your county auditor, how that's going to look when you get it, what you do with it, and how it's going to go into the annual report itself. You'll want to first request, if you haven't already, the abatement deduction information from the county auditor. And it might help if you use that term deduction because I think that's what they're expecting. That's what our county directors have trained on to the county auditors, is being able to provide the deduction amounts to the local units when it's requested. So what you see on the screen is a sample from Gordon County. What you get from your county auditor may not look like this. In this example, the county auditor has actually done the calculation for you, but that's not always going to be the case. They don't have to calculate it, and we've told them that. They just need to provide the deduction amount. But some county auditors, we know, have already gone ahead and made the calculation and provided it to you. So even if your county auditor does calculate it for you, you need to double check their calculations. You need to double check their work, because you're going to put that abatement amount in your report. It's going to become part of your note disclosures that we audit. So if it's wrong, it's going to be, if it's wrong in the report, it's going to be your issue that it's wrong. And so double check that if you get it from the county auditor. If when you're double checking that work, and we're going to go through what that multiplication equation is. If you come up with a different amount that they've provided to you, you'll want to contact them and see, well, what did they do to get to that amount, because you've come up with a different one. So for our example purposes today, let's look at these four to start with, and they include both direct and indirect abatements. So we're going to look at the direct one first. So for this first one, the information that the Gordon County Auditor provided is the parcel number, the name, that deduction amount, the authority that approved it, and the abated amount. Again, the abated amount is the calculation that they did for you. That calculation is that deduction times your tax rate, so your city or town tax rate. So you can see in the box on the left, the county auditor provided the deduction amount of $9,040. They listed the abatement authority was your town council, and they did that calculation of the abated amount and came up with $122.22. And they also put on there that it was real estate. You could have business, personal property, or real estate. This happened to be a real estate abatement. So what you will want to do to verify in this case, because the county auditor provided it, or what you'll want to do to get that calculation if they don't provide it, is to take the deduction amount of $9,040 times your tax rate. In this example, it happens to be 1.352%. So you'll take the 9,040 times 0.01352, and that'll get you to the $122.22. And then how that's going to look on the annual report and you enter it. Again, you can see on the left, it says direct agreement. So this box is where you're going to put your direct agreements. You'll list the abatement name, American Fiber Tech Corporation in this case, the purpose of the abatement program, which is, we just put economic development. The specific tax is being abated, so it's real property. And then the amount of tax revenues that have been reduced or foregone as a result of the abatement for this year. For this abatement happens to be that $122.22 that we just calculated. And then to just repeat, if your county auditor provides that, let's say you took the $9,040 times your tax rate and you didn't come up with $122.22, you need to go back to the auditor and say, what did you do to get to that? Because I come up with a different amount. And if you're sure your amount is better or it's more correct, then of course go with your amount, because it is your report, like I said, and so what you put in there, you're responsible for. So let's take a look at another one. I skipped over the TEC Incorporated and jumped down to Joyce Automotive. Their deduction amount was $3,791,570, and it was abated by the town council. So it's going to be one of those direct abatements, and you'll take the $3,791,570 times your tax rate of 1.352% to get to the amount abated of $51,262.03. And then how that's going to look is similar to the other ones. Again, I've already included the TEC Incorporated, and where the green area is where the Joyce Automotive goes. And it happened to be a business personal property abatement. So that's in the fourth column over. And the abated amount listed the $51,262.03. Now this bottom one isn't one that your council approved or authorized. It was done by the county council. So this one's going to be an indirect abatement. It was for Gordon Industrial Sales. The deduction amount was $228,862.43 times the tax rate of 1.352%, gets you to an abated amount of $3,094.22. And because this one's indirect, it's going to go in the bottom box. Remember, we looked at two boxes earlier on. Those ones, like the bottom one is the indirect. You can see I have that highlighted over on the left. And you just put the same information in. Gordon Industrial Sales is the name. It was an economic development abatement. It's a business personal property. And it was $3,094.22. Then when you submit all of that, and we come in to do an audit, and we take your annual report and we generate the financial statements, and the notes are also generated. So this tax abatement information will be in that note to your financial statements. And I'm sure you've heard us say before, we audit those notes because they're a part of the financial statement. Our opinion is on your statement and your notes. So if we find something wrong with the notes, it would just be like if we found something wrong with the cash balance of one of your funds, we're going to propose an adjustment to you. You'd have to go back into the annual report, make that change and resubmit, and we'd move on. So that's why this is important to get it in the annual report correctly, so that it comes out in the notes to the financial statements correctly. You don't have to go back in and make any changes for it. Okay, next up is unit question number 22 about a disaster recovery plan. And people are asking, well, what the heck is that? What does that mean? And it means just basically, what is your plan if a disaster happens? If you have a fire and your town hall burns down, or there's a flood and records or equipment gets damaged and information can't be obtained from what's ever left over. God forbid a tornado should blow through and destroy things, or even ransomware. What are you going to do if you're a victim of ransomware? Are you going to have any backups available that maybe you can reinstall instead of having to pay the ransom person. So with the increases in ransomware, we're seeing them more and more, and the other scams that are out there, and that always threat of fire or destruction. We're trying to get a feel with this question, or if cities and towns have any kind of plan for continuing operations should a disaster, including the pandemic, occur. If you remember back when COVID started, the continuing operations was something that we had put out in a directive that everybody should have on, if people are not able to come into the town hall or the city hall because it's shut down, or people are ill and not be able to do their job, how are you going to function? What are you going to do? These are all things you need to really think about before when you're standing outside your smoldering town hall and you realize that your records have been burned up. You want to think about those things now instead of then, and then you have to put some plan into action and you're not really sure what to do. So having a plan in advance is a great thing. When you get to answering this question, what you can see is the first available answer, but there is a drop down there. So the possible answers are yes, you have a plan through a vendor. For example, if you use Keystone, I believe they have disaster recovery plans built into or programs that you can pay for. I know a lot of software programs are going to in the cloud storage so that, if something happened in your building, your equipment gets damaged or a tornado comes through, you might be able to reinstall things from the backup that's in the cloud. Or a software vendor may have a backup of your information on one of their servers that you're able to get if you need to. So if it's through a vendor, you want to say yes to that one. If you happen to have something else in mind, an in-house process for backing up or having offsite storage, click the middle response there. For example, if you have written hand-posted records, your ledger, you write your ledger out, your transactions. What are you going to do if that's destroyed in a fire or if a flood comes and you can't use those paper records anymore? You need to have some kind of a plan involved, and so that would be more of a in-house type of a process. And then if you don't have any plan, don't be afraid to click no. It's not going to generate our special investigations division to kind of swoop in and start looking at stuff. Just be as honest, and if you don't have one, that's going to be information to help us in planning future trainings and future audits. If you need more information on disaster recovery plans, you can look in our information technology manual. Here's a link for it, and on page 9 is where it talks about it. It uses a different term. The manual refers to it as contingency planning, but it's pretty much the same thing, and it walks through some considerations that you need to think about in developing your plan. Now let's take a few minutes and talk about capital assets and depreciation, because we're still getting a fair amount of questions. And so I know if we're getting a lot of questions, there are probably even more questions out there that aren't being asked. So we thought this would be a good time to go over this. As with the conduit debt, we did a lot of training over this over the past summer. Here, I want to show what this is going to look like actually in the annual report. So if you've got more questions about what is a capital asset or what's my threshold or depreciation, what is it, why am I doing it? Again, you can refer back to those previous trainings and materials from last year. What you see on your screen is an example of real data that was entered by a town, submitted on their annual report. And it looked very good just in going over some of it. So I wanted to use it as an example and point some things out. In the top two sections are for your capital assets, and the bottom section is the accumulated depreciation. And we've talked before about assets that don't depreciate and assets that do. So that top section says governmental activities, non-depreciable assets. And there's land of $55,500 and construction in progress. And not everybody has that, and this one happened too, so that's why I picked it, because I wanted you to see what it looked like. At the beginning of 2021, this unit was doing construction. and they had accumulated $46,038.51 as of January 1st of 21. And then during the year, at some point, that became completed. They were able to use whatever they were constructing. Let's say you're building a community center and you won't want to move it out of construction in progress until it's no longer in progress and it's finished. And so you're able to use it. So that's why there's an amount in the reduction column of the same amount, 46,038. So by the end of 2021, this unit didn't have any construction in progress. Moving down to the next section, these are assets that do depreciate. You've got infrastructure, beginning balance of $2,104,000, your buildings, your improvements other than buildings, your machinery and equipment, and again, books and other. We have that on there because libraries capitalize their books, and we don't want to have an annual report just for libraries and one for just cities and towns. So it's on there. Most of you will not have any books, so don't get freaked out if you see that and you think you have to put something in there. You might have to put zeros in there because those boxes will probably say required in blue letters, indicating that there's got to be some kind of information in there before you can even submit the report. So if it's zeros all the way across, that's fine. Don't be bothered by that. And then the bottom section is the accumulated depreciation. So you'll notice that mirrors the middle box and that it has infrastructure, buildings, improvements, machinery, equipment, and vehicles. Doesn't have the land or the construction in progress because we don't depreciate land or construction in progress. This unit had gone back and determined at January the 1st what the accumulated depreciation was on their assets. They went back and looked at assets when they were acquired, how long they have had them. They went through the straight line depreciation. They determined estimated useful lives and calculated what, had they been recording that all along, what the balance would have been at January the 1st of 2021. Then in the additions column, that's going to be the depreciation for 2021. So if you look in the machinery, equipment, and vehicles, they had $11,381.42 of depreciation in 2021 on all of their equipment. So that's why that's shown as an addition. I've had some questions come in about they thought the depreciation would be a reduction, and you're accumulating your depreciation over the year, so that's going to build up. As long as you have that asset, it's going to increase. So that's why it's an addition, $11,381.42. They didn't get rid of any machinery and equipment in 2021, so there's no reduction to accumulated depreciation. And if you hop up to the middle section on that line for machinery and equipment, there's no reduction there either. Had they disposed of an asset that fell into the machinery and equipment, let's say they sold a truck, they would go into their capital asset records, and the value of that truck, or the acquisition cost, I should say, of that truck that they had recorded, they would show that as a reduction in the reductions column, and then the related accumulated depreciation on that truck. Maybe it was fully depreciated, or maybe it had a couple of years left on it and they got rid of it anyway. The associated accumulated depreciation on that truck would pull out also, so it would come off. The next slide just shows the same thing for one of your utilities, so it's going to be no different. You've got non-depreciable assets, depreciable assets, and your accumulated depreciation. And I just selected the water utility. The unit that I took this from had other utilities, but I just wanted to look at the water. No additions to assets during the year. But again, the bottom, you can see we have additions to the accumulated depreciation, because even though we didn't buy any new assets in the year, the ones that we had are still depreciating. We're still taking 1 year of depreciation for 2021, and that goes in the additions column under accumulated depreciation. So let me, now that I've shown you that, let me take a look at a very simple example, and it involves, say, the town of Toddville, and I only have one capital asset, and it's a truck. That truck was purchased in 2017 for $60,000. The truck is, for our example, correctly shown in the capital assets at historical value, which is $60,000. We use straight line depreciation. We've determined the estimated useful life is 7 years for vehicles. And you've heard us talk about that before, that in my little town, if that's the only asset I have, I'm probably not going to use that truck very much or very hard. So we've said it will probably last 7 years. We might keep it for 5, we might keep it for 15, but for depreciation purposes, we're going to say 7. If you get in a bigger city, had that same truck, they might use it every day from 8 to 5, and they're probably harder on it than I'm going to be, so that truck may not last that long. And so their estimated useful life might be less than 7 years. So it's going to be different for each unit. You just have to document what you've come up with as your estimated useful life. And then the last bullet point, our local policy is not to depreciate in the year of acquisition. So you can see we purchased this truck on my birthday, November the 2nd, 2017. So we're not going to depreciate it for that year. You could have a policy that says you're going to take 1 full year of depreciation in the year that you bought it. So whether you bought it on November the 2nd or January the 2nd, if that's your policy to fully depreciate 1 year, the year that you buy it, you can, or you can choose not to. And I've seen some that get a little complicated, and they'll say if we purchase an asset after July the 1st, we'll take a full year, and if it's before January or after July the 1st, we'll take a full year. If it's before July the 1st, we won't, or some kind of combination. I think it's just easier to say we're either going to depreciate a full year the year we buy it, or we're not. So in this case, we're not depreciating it in 2017. So the depreciation calculation there in the middle shows $60,000 divided by 7 years comes out to $8,571.43 a year. So as you move across the screen to your accumulated depreciation at the beginning of the year, remember we bought this several years ago, so for our 2021 report, we've got to come up with a beginning accumulated depreciation balance. And so we go back and we look year 1, 2018 was the first year that we depreciated that $8,571.43. We do it again in 19 and 20. So at 1/1 of 21, our accumulated depreciation is $25,714.29. So we have accumulated that much depreciation for those 3 years, and you can follow the arrow and see that where it will go in your annual report in that beginning column, the beginning balance column. Then our additions to depreciation was going to be the $8,571.43 for each year. So our depreciation in 2021 is going to go in that column. As you do the math across, you'll come up with the ending balance of accumulated depreciation at the end of the year of the $34,285. Again, that's a very simple example where there's just one asset, but I wanted you to see how you come up with those beginning numbers and where they go in the report, and your depreciation for the year and where that goes in the report, and how your ending balance will come out. That it will go in your note disclosures again. Well, that's all on capital assets. Now let's talk about some of the other questions that we're getting, and the next one is advertising. The advertising requirements in the statute have not changed from last year. So what you see on your screen is a clip from the user guide and the frequently asked questions. For cities and towns, you're going to publish your annual report once within 60 days. And we kind of made it, or tried to make it easier for you on what gets advertised and what you can do with that. So you can print a report out and take it to the newspaper of what needs advertised. So in the system functions section on your main menu, it's down toward the bottom. One of the choices is annual report outputs. And when you go there, pardon me, and scroll down, you can see in the box there's an advertising options and a link for your cash and investment combined report. And all you do is print that out. It has everything you need, and you just get that printout to the paper and they can advertise it. They can publish it and advertise it for you. Then people like to ask, what do we do about the proof of advertisement? Do I need to upload that into Gateway or mail it to you or anything like that? And the answer is no, you don't. Again, from the user guide, no proof needs to be sent to the Board of Accounts. You just keep that in your files. Usually with the claim that you're paying for the advertising with, you can just attach that proof to your claim, and that's good enough. And then another question from the user guide, frequently asked questions, is what if the advertised report has errors? What if I go ahead and advertise it, and after the 60 days, I realize there was an error, an adjustment that needs to be made, and I have to go back in and unsubmit the report and make those changes and resubmit it? Do I have to re-advertise it? And that's kind of up to you. You would need to review the publication statute of 531 2.3 and determine if the report that as it's advertised would be misleading to a reasonable person. And if you think it would be, then just go ahead and re-advertise it. Or you can make a decision, just to be safe, you want to re-advertise it. If something was $1 off and that was what you changed, that might not be worth the money, obviously, to re-advertise it. But if it was off $100,000, a reasonable person, that might be misleading to them, and I would probably recommend going ahead and re-advertising at that point. So it's going to depend on your situation and what your change was, what your error was, or what you had to move to determine if you need to re-advertise. And before I turn it over to Susan, we had a request for CARES and ARPA information that would go into the grants section. So of these, of the items there, the federal program name, the federal agency, the pass-through, and the assistant listing number are the most important. So when you get to that section of your annual report, you'll see those things being asked for. So you're going to make sure you have the program name, the federal agency, the pass-through, and what used to be the CFDA number and is now the assistance listing number. So for an award number, there isn't one provided. Normally your other grants that you get, like maybe from the state or from the Department of Justice or something, your grant paperwork will have the grant award number in it. It'll have that assistance listing number in it. The way that CARES and ARPA were rolled out, that didn't happen. That was just money that was, here it is, you're going to get it. They didn't have an award number, but you still need to put something in those boxes. So you can do simply like calendar year or CY 2021 or FY 21 for fiscal year 21. Just something to indicate that it was for 2021. Get that in the in that column. What you're looking at on the screen is the award number, the second from the right. Just something like that in there. But the program names need to be correct. So for CARES money, if you're still spending that, it's Coronavirus Relief Fund, and ARPA money is Coronavirus State and Local Fiscal Recovery. That's the technical name of it. It was through the ARP, American Rescue Plan Act, but the actual program name is that Coronavirus State and Local Fiscal Recovery. They both came from the Treasury and passed through IFA. The CARES number is 21.019. The ARP number is 21.027. And those are for the basic. There are other CARES grants out there that might be specific, like for an airport, that would have a different listing, assistance listing number. So you want to make sure you have that. We have provided before, like the SAMS website, where you can go and click online and type in either the number and you're not sure of the name, or the name and you're not sure of the number, and it can get you all that information. If you need that, shoot me an email. It was in some previous materials, so if you have the materials from maybe the last few months of last year, I'd go back and look there. If you still don't find that link, shoot me an email and I can send that to you. The other columns in the grants section are going to be amounts from your local records or from your ledger. It's going to ask for the amount received, the amount spent, the amount of insurance in effect, which is normally going to be 0 for these. There are some other columns that are all financial that are going to be particular to your unit, so you'll want to refer to your records for those. And with all of that, I am ready to turn it over to Susan.
Okay, thanks, Todd. What we want to do now is just go over the American Rescue Plan Act final rule that came out about a month ago now, and go over some of those changes. We'll also review the basic requirements of that act as we go through this. So the first thing that I'd like to cover is are the effective dates for the plan, because there's a lot of dates that you have to remember. First of all, the final rule, again, that just came out, does not really take effect until April 1 of 2022. Now, the interim final rule, you know, we've gone through that pretty extensively in our training. That remains in effect until April 1 of 22. But there's no audit exception to uses that are permitted by the final rule, even if those disbursements were incurred prior to April 1. So if it's allowed in the final rule, you can do that now. You don't have to wait until April 1st. And then, of course, this rule has been around since the beginning. The funds that you received can be used for costs incurred on or after March 3rd of 2021. And then the funds can be used to cover costs incurred or obligated by December 31 of 2024 and expended by December 31 of 2026. So there's still a lot of time available to use these funds for this grant. Now, you remember we've talked about this a lot, probably nearly every month last year, that there's 4 main categories in this act. One, there's the replacement of public sector revenue, the government services section. There's support for the COVID-19 public health and economic response. There's premium pay for eligible workers performing essential work, and then there are investments in water, sewer, and broadband infrastructure. Those are the same, those are the 4 main categories, and those categories did not change with the final rule. So we'll go ahead and talk first about the government services and revenue replacement section. What the Act and the final rule say is that you may use funds up to the amount of revenue loss for government services. And generally, services that are traditionally provided by the recipient governments are government services, unless Treasury has stated otherwise. And there are a list of those that are not, although they might be government services, they're not permitted to be paid from ARPA funds. So we have some examples of government services, and this is provided in the final rule. They did a really nice job in the final rule of giving plenty of examples. So maintaining or funding of infrastructure, including roads, is a government service. Modernization of cybersecurity might be in this section. Health services, some type of environmental remediation, school or educational services, or of course, police, fire, and other public safety services. And the presumption that is stated in the final rule is that as long as it's not prohibited and it's generally a service that's provided by your government, then you can include it in this section. Okay, now the final rule offers a couple of ways that you can calculate your revenue loss. Actually, the first way is not a calculation at all. They just offer you a $10 million standard allowance, and that is new with the final rule. Treasury will provide a mechanism for you to be able to select the standard allowance, or if you would like, you can go ahead and do the calculation as before, the revenue loss calculation. If you choose to calculate the revenue loss, you're going to want to review the formula in the final rule because there were some tweaks made to that, especially in the area of utility revenue. But back to that mechanism on the standard allowance, once you select that standard allowance, then that's fixed for the life of the program. You can't go back and forth on that between the selection of the standard allowance and the calculation. For a lot of you, most of you actually, the $10 million will be the majority, if not all, of the award, and you can spend all of that up to $10 million on government services. This does not increase your allocation amount. For example, if you were allocated $3 million in this award, you're still going to get just $3 million. You're not going to get 10, but you can spend the entire $3 million on government services if you want to. Also, if you make this selection on the government services side, it doesn't mean that you have to spend all of your award on government services. You can certainly go ahead and spend your award on those other 3 categories as well. Okay, now we talked about some restrictions on use. Even though these may be or are government services, they're not allowed to be paid for from the ARPA funds. And that would be an offset and a reduction in net tax revenue. It would be deposits into your pension funds or other general restrictions like you can't pay your debt, you can't transfer to debt service or replenish your financial reserves like your rainy day fund. You can't put it in there. You can't satisfy your settlements or judgments. You can't have payment on any projects that create a conflict or contravenes the purpose of the American Rescue Plan. And then there are other laws that might apply to that too, like the uniform guidance rules that we've talked about before. So no doubt a lot of these might be government services, but those would not be allowed. So just as a reminder, remember for audit purposes, you'll be selecting your method of revenue loss, and then you'll want to make sure that your use is a government service, which again is presumed to be any service that you would normally pay for unless it's prohibited by the final rule. Okay, so there was the category 2 of responding to the COVID-19 or its economic impacts. And the final rule has provided a lot of lists for you to make it more clear as to what they're thinking about when it comes to responding to the pandemic. For public health, they have lists involving mitigation and prevention, medical expenses, behavioral health care, and responding to violence. All of those might be things that you might want to consider as you respond to the public health emergency. As far as the economic response, the final rule has organized the response by the type of beneficiary that you might consider, like households or businesses or not-for-profits. And then the final rule gives a lot of direction on presumptions of some populations that are more affected than others. And if you do have some of those populations that are more impacted, then there's a broader use of funds for those that are disproportionately impacted. So you'll want to take a look there if that is something that your city or town is considering as far as an economic response. And then there are other purposes and responses that are available, of course, that are consistent with the final rule. None of the lists in the final rule are exhaustive lists, but they should comply with the goals of the American Rescue Plan Act. And remember, it can't be an excluded use ever, like the transferring to rainy day funds. So again, we want to make sure that you know what's expected for your audit. Make sure that as you're going through, if you're spending money out of this category, make sure that you have documentation on the determination of your use. Was this a Treasury final rule and enumerated use, or was it a program that you created and designed to respond to the public health or economic impact? Just make sure you have those determinations available for audit to show how the use of those funds responds to the pandemic. And then, of course, you need your corresponding documentation. If there's any ordinances or resolutions, related to responding to the public health emergency. If you're working with not-for-profits or other businesses, the contracts or grant agreements that you've entered into with those are things we're going to look for in an audit. And then just make sure you review the State Examiner Directive 2021-1 on the appropriate accounting procedures and the uniform compliance guidelines that are applicable to any grants. Okay, this next category, of course, is premium pay. I think that's probably where we get most of our questions. And that's to respond to workers performing essential work during the public health emergency by providing premium pay. And that's for, again, government workers who are performing essential work. Or you can provide grants to eligible employers that have eligible workers who perform essential work. So the first thing that you have to do, and things we're going to be looking for in an audit, is to identify an eligible worker. The Act itself and the final rule have definitions of who's considered an eligible worker, which includes government employees. And it allows for your executive to name additional eligible workers. And then you need to make sure that the eligible worker performs essential work. So the final rule has clearly stated that essential work is not working from your residence or teleworking. It's actually regular in-person interaction or the handling of items by the public. So you need to also document that the premium pay that you are paying is not only for an eligible worker, but it's for that worker who's performing what would be considered essential work. And then the final rule clarified how it responds to eligible workers. And there's basically three categories that you have to think about. Well, it's not three categories really, but three ways. So first of all, it's going to respond to a worker if that worker's income is below certain thresholds that are stated in the final rule. And Treasury has a list of those corresponding incomes. The second one is if that worker is non-exempt from the Fair Labor Standards Act. So if the person's wage is either below that threshold or they're non-exempt from the Fair Labor Standards Act, then they're going to be a worker that is considered for premium pay. If you have someone that doesn't meet either one of those, in other words, their income's over the threshold and they are exempt from the Fair Labor Standards Act, then you have to have some written justification to Treasury about why that person meets that requirement or how you're responding to that worker. So keep that in mind, again, as you're going through these steps of deciding who to pay premium pay to. Now, the final rule also had some other parameters. This is still up to $13 an hour. So it's still an hourly rate, but it can be paid in lump sums or in installments. So if you're going back in a period of time, let's say to sometime in 2020, and you want to pay your workers a certain dollar amount per hour for the hours they worked in March, April, and May of 2020, then you can calculate what that award is or that premium payment is going to be for them, and then you can pay that in a lump sum to them. You can make these awards to hourly, part-time, salaried, or non-hourly workers. And it does need to be in addition to wages that have already been received, and it can be paid retrospectively. We've kind of covered that before. It cannot be used to reimburse your city or town for premium pay already received by a worker if you've made those payments already. And you can't pay it to volunteers. That was new with the final rule. I want to talk specifically about elected officials. We do have the premium pay directive that the state examiner is currently amending based on language in the final rule. So that is changing. It's not out yet, but I would expect it to be out soon. When the grant was accepted, there was a clause in the award terms that talked about compliance with 2 CFR 200.318, which is a conflict of interest policy that's been clarified by the final rule. And it's our audit position in that final rule. It says that elected officials are not eligible for premium pay. And elected officials cannot steer funds to projects in which they have a financial interest. That has been made clear by the final rule. So unless Treasury states otherwise, this would not be an appropriate use of the ARPA money to pay premium pay to elected officials. Now, if you have made payments to elected officials already, in premium pay, we are also coming out with a memorandum on offering potential solutions for that. So I would expect to see that soon as well. I just don't know exactly the date that that's coming out. But if you haven't made payments to premium pay to elected officials, then do not do that. If you have made premium pay payments to elected officials, watch for the memorandum that's coming out, which is going to offer you some solutions for that. All right, and then the last category, of course, is the water, sewer, and broadband infrastructure. In the interim final rule, it had kind of limited the projects that you could undertake by limiting to those that were eligible under the Clean Water State Revolving Fund or the Drinking Water State Revolving Fund. But now it's expanded those in the final rule. So there's a lot of additional eligible projects, and you'll want to go to the final rule and take a look at those lists. But some of them that might be most interesting would be the stormwater infrastructure, residential wells, lead remediation, rehabilitation of dams and reservoirs, and various others on there. So if those are of interest to your city or town or needs of your city or town, then you might want to go ahead and take a look at those. And then for broadband, again, you'll need to identify, according to the final rule, an eligible area for the investment in broadband infrastructure. Specifically, the final rule says you need to design a project to meet certain technical standards and require enrollment in a low-income subsidy program. And this also includes cybersecurity projects. So if that's something that is a need for your city or town, you'll want to take a look at the final rule and look at the types of investments that they're thinking about for the use of these funds. So just wanted to remind you, there are certain prohibitions on use. For example, payments to debt reserve or rainy day and those types of things that were on a previously listed slide. So watch out for those. Make sure that you document everything. Keep your ordinances and resolutions, of course, for audit. Any notes that you have or any attorney opinions that you have, just keep all of those for audit so that our field examiners can take a look at them. Make sure you have sufficient documentation for your disbursements. Like always, you should have a contract or some type of an invoice, a grant agreement, payroll records, etc. Make sure that you can document those disbursements. As we've talked about in previous training, make sure that you have sufficient internal controls over the use of these funds so that you can make sure that they are used properly in accordance with the Act and the final rule. And then Treasury reporting requirements, keep that in mind. I think the first report for non-entitlement units is April 30th. So we'll try and talk about that more at a later training once more information comes out from Treasury on what's required there. Okay, and I have some updates for you as well. On the first one, this is coming soon. So it's not out yet, but I wanted you to know that it's coming. Our audit position involves LIT certified shares. And it's come to our attention that LIT certified shares have been deposited into many different funds other than the general fund. For example, we have seen where LIT certified shares have been deposited directly into rainy day, to MVH, directly to a utility fund, to park funds or other cumulative funds. But our audit position has always been that LIT certified shares have to be deposited into the general fund. And that's based on fund accounting principles. So I wanted you to know that a memorandum is coming out to explain all of this. I would expect it to be out yet this week. But I also want you to know that this memorandum is not going to affect anything in 2022. So if you're a city or a town who has put LIT certified shares directly into a fund other than the general fund, it's not going to affect anything for 2022. We're not going to take audit exception to that. But in 2023, we're going to expect that that will be cleared up. So take a look for that memo, and we can discuss it further after you've had a chance to read it at our next monthly meeting. Be happy to discuss that more, or you can send us an email if you have a particular question on that. Then we also have some more training opportunities available. We'll be at the Institute and Academy in Muncie. That's from March 13th to the 17th. We would encourage you all to attend. Board of Accounts will be there on March 14th. We'll also have our next monthly meeting on April 7. And then I wanted to, again, let you know about some things coming. The State Board of Accounts Resource Library. A lot of you are probably familiar with our website. You know, we have a lot of information on there. We have information related to, you know, our manuals and the directives and the bulletins, audit reports, you know, and all of that information. And we've had one of our directors work really hard to make that website or that resource library a searchable database. So now you should be able to go in, it's not out yet, but when it comes out, you should be able to go in and search a particular word like maybe transfers or appropriations or deposits, and then the information that we have related to that subject will come up rather than trying to go to the index for the bulletins or search through 10 years of bulletins to find the right article. You should be able to just enter a keyword and it will come up. So we're all very excited about that, and we will probably have a special training session on that new resource when it becomes available. So look for that. We'll record it, but we would love it if you could attend in person, or not in person, but virtually, so that we can go through examples with you. And then also, you've probably seen we have a new title to reflect our responsibilities. And just in case you happen to notice that, we're still directors, but it's now Government Technical Assistance and Compliance. Oh, and one other thing I wanted to mention that's not on any slide, but it was information that came in this morning. Make sure that you are up to date on your bank reconciliations, because we've had more and more information about counterfeit checks or checks that weren't written by the unit, but somehow they are getting passed through the unit's bank account because it looks like a check that was written by the unit. So make sure you're up to date on your reconciliations so that you can catch any, you know, checks that weren't written by you that may fraudulently go through your account. So I just wanted to throw that out there as well. Otherwise, that's all I have, so we can open it up for questions now.